Well, thank you so much for the kind introductions before, and thank you so much for coming this evening. It's my first time in Brisbane. It's a great city, and it's great to be here at an event hosted by the university and these other distinguished groups. Apologies in advance. I woke up this morning with a bit of a cold, so my voice is a bit strained. If you can't hear me at the back, I'm hoping you can, but if you can't, let me know. What I want to do in the sort of 15-20 minutes that I've been given is to talk to you about this idea of stranded assets. And it's something that you may have come across. ExxonMobil referred to it the other day, as was pointed out, that they don't think their portfolios will suffer from stranded assets. It's one of those things that's propped up within the climate change discourse, but also within the environmental discourse. So I want to talk you through what that means and how we look at it at Oxford and what we think the issues are. And then I'm going to talk a bit about a bit of work that I did with colleagues at Oxford looking at how China's demand for coal is changing, and changing as a result of different environmental factors, and then what that might mean for Australian coal assets and the Australian coal economy. And I should say that one of the co-authors of that report is here this evening, James Tilbury, who's there and is Queensland based, and so after I fly off tomorrow, I think he's flying off tomorrow as well, but he'll come back, I think. And if you have any questions about our work and the work that we did, you should approach James afterwards. But so to the first part of what I want to talk about. So what are stranded assets? Well, stranded assets are assets that have suffered from a premature or unanticipated write-down or devaluation, or in extremis a conversion to liabilities. This is not a new thing. It happens regularly. It's part and parcel of the creative destruction that drives forward capitalism. And it often is created as a result of changes in consumer preferences, shifts in technology, changes in regulation, accidents, extreme events. So examples might be, in the latter category, things like the BP Gulf of Mexico accident, Macondo. You could look at, and you all know, technologies like Betamax or companies like Kodak. They're all examples of companies with assets that have suffered from asset stranding. Similarly, you could look at in the news and look at companies like BlackBerry and Nokia and Microsoft and see that they're probably likely to have lots of stranded assets soon too. But so it's something that's not new, and I guess what is new is that there are a confluence of risks, all of which are related to the environment in one way or another, that are coming together and stranding assets at a rate, at a pace above and beyond what you might expect to see in different sectors of the economy day to day, above and beyond what we have seen in different sectors of the economy over the last 20, 30, 40 years. So it's a discontinuity, these environmental risks. And I'm going to talk a bit about what those risks are. So we have broken these down into sort of 6 buckets of risk, the first of which relate to environmental challenges of various kinds. Now, physical climate change, anthropogenic climate change is first among them, and we heard earlier about some of those massive challenges. But there are others that are also connected to climate change, I should say, like biodiversity loss and habitat loss and water constraints and so on, that are affecting value in different sectors as we speak. They have done so, and that will continue. Another area of risk is regulation, often in response to some of these environmental challenges. So carbon pricing in its different forms, whether it's traded or via carbon tax, air pollution regulation, regulation in relation to local environmental challenges, local environmental pollution. All of that, lots of that's being introduced as affected value. We have new technologies and innovation that can shift value and strand assets. So in the renewable space, you've seen solar PV prices, for example, falling by 44% since 2009, and onshore wind prices falling by 15% over the same period. Those trends, and they're following quite well-established cost curves, those trends have very significant implications for utility companies, for power markets in different places, And there are other examples of disruptive technologies that can affect assets, LED light bulbs in the future, much cheaper. Electricity storage, for example, could be another disruptive technology. So those are likely to have big impacts. Another area is evolving social norms. And this can range from consumers wanting to purchase goods where they know the origin of those goods and they know that they've been produced sustainably, so FSC certified wood products or buying organic or whatever it might be. But that extends all the way through to things like the fossil fuel divestment campaign. I know some of you here will be involved in that, but that's something that has emerged very rapidly, unexpectedly so, and can have an impact, and is having an impact, on different fossil fuel companies and fossil fuel assets. So that's an example of how social norms are changing and how that can then have an impact on the real economy. Another area is resource markets, resource prices, and how those are changing as a result of new abundancies and new scarcities. So a good example of abundancy would be the emergence of shale gas in the United States. That's had a big impact in the US power market. It's had a big impact as a result of displacing coal in the US and exporting it to Europe, so it's had a big impact in Europe. And it might have big impacts in other places too. In terms of scarcities, you could think about phosphates in agriculture as a potential constraint, and there are other examples. And then finally, the final kind of area that we look at, and will increasingly look at, is litigation. And that's an area that is both new and also very old. So environmental groups, activists, citizens have been bringing cases related to the environment in different jurisdictions for a very long time to get compensation, to change the law and so on. But I guess there's a new generation potentially of cases being thought of, being brought that relate to shifting things like fiduciary duty and responsibility to take account of climate change and other environmental impacts. And also the idea of carbon liability, so the idea that companies and boards, directors of companies might be held liable for the carbon emissions their companies produce. Now that's probably a very, very far off thing, but it's something that people are thinking about, talking about, and those cases when they're brought, that's an active point of discussion at the moment. I'm just going to before I do one other thing, the other thing that is important to bear in mind and is central to our work is that, one of the things we're trying to test through our work is that these risks are rarely understood, that they aren't properly factored into the decision-making that most investors take, let alone other agents in the investment chain. So most companies, most investors don't really understand these risks. To the extent that they understand any of them, it tends to be in relation to physical climate change. Obviously a lot of data there. The insurance industry kicked off a lot of this analysis, but also on regulation. So there's, they hire people to look at regulation and policy. So to the extent that they have any foresight on these issues, it tends to be in those two areas, and even then, it's very poorly applied in decision-making processes. And one could point to the Exxon example from yesterday, the day before yesterday, as an example of that. And finally, we think that there are significant benefits associated with managing these risks. So in addition to taking action to hedge these risks, manage your exposure to them as an investor or as a company, if you do so, there are likely to be benefits to your bottom line. So if you, as a firm, take decisions to preempt, say, new government regulations, that might improve your resource efficiency, which might then improve your bottom line. So those co-benefits are important to recognise. I'm just going to talk very briefly about some of these risks in a bit more detail. Now this slide is from Munich Re, a big insurer. It's always nerve-wracking to talk about climate change and climate science when you've got a distinguished climate scientist on the panel, but this is all from Munich Re, so I'm not to blame if it's wrong. But it's a 33-year it's a 33-year data set of loss events related to a bunch of different things, but you can see that in red, I hope you can see anyway, in red at the bottom are geophysical events, things like earthquakes and tsunamis and so on. And there's obviously a lot of annual variation between years, but it stays sort of broadly, roughly the same level over that 33-year period. And then you have the meteorological events in green, the hydrological events in blue, and the climatological events in yellow, so things like storms and then floods and extreme temperature events and so on, increasing over that 33-year period. And from an investor perspective, it's not so much the number of events that's interesting, it's the size of the losses. So this next slide, also from Munich Re, does that. And it's really the two lines over that 33-year period. The top line is the one you want to track. This is the value of losses, overall losses, as a result of those events, adjusted for things like inflation. So it's in real terms, things in 2013 prices. So these loss events are now costing in real terms significantly more than they were in 1980. So from 50 billion to something like 200 billion a year. I mentioned resource markets and commodity prices. This is a slide from work that the OECD and the World Bank and others have done, looking at how commodity prices have shifted over the last 111 years. So this goes from 1900 to 2011, and again is adjusted for inflation and things. And basically what we've seen is that the very significant falls in resource prices, commodity prices from 1900 to 2000, were basically completely wiped out in the 11 years from 2000 as a result of emerging economies. So it's a demand story, the emergence of China, but also growth in India, Brazil, and so on. And that obviously has an impact on sectors that are dependent for resources as inputs. This has obviously benefited Australia, the story, but that's had very significant impacts. Another area that's been talked about, and we'll probably talk about more, is regulation. So this is from a recent study from Globe International Organisation of Parliamentarians. They commissioned work from the London School of Economics. This was recently published and just tracks the number of laws that have been introduced related to climate change over since 1997. And it shows that as of 2013, there are 487 laws relating to climate, up from less than 100 in 2002. And I think it's right to assume that the number of these laws will keep increasing, and that's because in many regions like Southeast Asia, Middle East, North Africa, Latin America, people are actively talking about the introduction of new laws. In many places, existing laws are being tightened. In other places, in some of the same places, mandatory or voluntary schemes are becoming mandatory. I do realise that I'm talking to an Australian audience in Australia, so you're right. I know what you're thinking. Hang on, there's something wrong here. There is. Your country is one of the few that has backtracked on the introduction. I was trying to backtrack on some of these laws. The other being Canada. So we're a good company, I suppose. But I think despite that exception, the trend will continue and will have big impacts. Now, I talked about costs of different technologies, and I apologise, I know you won't be able to see this. I'm sure, and I'm hoping that the slides will be available for your perusal afterwards online or something. But basically, the key thing here is that between 2009 and 2013, the costs of a brand new gas-fired power station and a brand new coal-fired power station increased by 44% and 40% respectively. And the prices of solar PV and onshore wind and so on fell. So the most significant renewable technology platforms saw these big cost reductions. And that means that when they're well placed, they're cost competitive with traditional conventional power. And that trend is set to continue, and that will have a big impact on fossil generation capacity. Now, one area where this has had an impact already is in Europe, and this slide is a screenshot from a Bloomberg terminal, which I don't recommend you try to get to use or play around with in due course. It's sort of a bit like an MS-DOS, and it's very boring, but it illustrates the point, which is that you've got utility share prices here for some big European utilities. The one in grey is E.ON, the one in green is RWE, pink is Endesa, a Spanish utility, and blue is Drax. Orange is Scottish and Southern, which is an exception, the reason for which I'll explain in a second. But from 07, 08, which is when their share prices were at their height, they've fallen significantly. And that's resulted in hundreds of billions of euros being wiped off their market capitalisation. And that's a result of two things. The first thing is renewables deployment in Europe completely caught them off guard. They had no idea that renewables was going to be deployed so quickly in places like Germany and Italy and Spain. And the thing about renewables is that they produce electricity at almost zero marginal cost. So when you get more renewables on grid, it lowers the average wholesale price, and that affects businesses, utilities, power generators with lots of thermal power in their portfolio. So this is exactly what happened in Europe, and that's affected their share price. The other thing that's happened is that as a result of low EU ETS prices, emission trading scheme, carbon prices in Europe, and also the shale gas revolution in the US, pushing coal into Europe quite cheaply, coal has suddenly become quite cheap, a perverse consequence of these things. And they built a lot of new gas-fired power stations. Those have subsequently become stranded. They've been mothballed, they've been closed, and that's again affected their share price. SSE is different because it's got a diversified portfolio with lots of renewables in their portfolio. The ones that have seen their share prices fallen by such a long way are now trying to get more renewables into their portfolios to offset some of these effects. But they have, because they've lost so much market capitalisation, they basically run out of cash, or they're severely balance sheet constrained, so they don't have the money to do that transition, which throws up all sorts of interesting questions. But this is a real example. My point here is that this is not something that's far off and distant, it's immediate and happening, and the same story could pan out in Australia quite quickly, probably will, in fact. And one thing I just wanted to emphasise was in relation to technologies and everyone underestimating their deployment, particularly renewables. So, you saw this with the utilities in Europe. Investors have also consistently underestimated this stuff. The International Energy Agency, which keeps coming up in Australia as a sort of gospel-like organisation. But they get it wrong too. So I just wanted to highlight how they got it wrong. This is from the OECD analysis. Basically, they publish a big review each year with the World Energy Outlook, which projects forward what they think different technologies will do. This is what they think the global share of renewables will look like in 2030. So in 2004, they thought renewables would kind of stay broadly the same. The following year, several years later in 2007, they revised their estimate. In 2008, up again, and then last year in 2013, they revised it again. That goes up to 2035. And so the corollary of that is less fossil fuel on the system, and expect that there'll be further revisions as renewables deployment exceeds expectations. I'm going to fast forward a bit. So look, I've sort of explained how I think some of these risks are material and how they might be accelerating. Now, I'm going to talk a bit about this bit of work we did looking at China's demand for coal, how it might be changing as a result of some of the things I mentioned, and what that might mean. Now, China consumes half the world's coal, but interestingly only became a net importer of coal in 2009. And since 2009, it's really driven a whole bunch of expansions in coal production. It's helped buoy the price of thermal coal and metallurgical coal. And in response to that, you have coal miners in Australia and elsewhere looking to expand production to meet what they think will be a continued ongoing growth story. Now, what we did, so as I said, we looked at a bunch of different things going on in China. We looked at carbon pricing and trading, so the Chinese are introducing pilot emissions trading schemes in different provinces in China at the moment. I've been doing a bit of work on the Shanghai one, and they plan to expand this to a national emissions trading scheme in a very short period of time, in a couple of years. So quite ambitious plans. We looked at the chemical sector and coal to liquid, so how those sectors might grow or contract and how efficient they might become. We looked at debates around coal quality, so the Chinese have been thinking about restricting imports of coal from places with low quality coal. We looked at energy efficiency, which has been central to the previous 5-year plan. The current 5-year plan will be absolutely central to the next 5-year plan. We looked at environmental concerns, so protests and things like that. We looked at gas and how that could impact coal. We looked at the efficiency of the iron and steel sector, and also efforts to try and close down the least efficient iron and steel producers. We looked at air pollution. We looked at renewables, and also hydro and nuclear power deployment and how that might displace coal. And we looked at water constraints, water being a very, very significant input, both the mining stage and also at the point of combustion for coal. And I won't spend too long explaining all this stuff, but basically we did an analysis looking at each of these different things and seeing whether they would have an impact or not. And then we analysed the extent to which they would have an impact on different time horizons. So would they have a slight, moderate, significant impact over 5, 10, 20 years? And the colours probably don't come up correctly, and it's probably all too small, but suffice to say that in the near term, things like carbon pricing and renewable energy deployment are going to have quite a big impact, and then more of those things become orange and red the further out you go. The thing to say is that in parallel to producing this work and afterwards, there have been lots of analyses produced by financial institutions, big investment houses, so Goldman Sachs, Bernstein, HSBC, Citi, Deutsche Bank, all of whom have said that they think demand for coal from China demand for thermal coal from China will peak any time between 2016 and 2020. And their analysis looks at some, but not all of the things we look at. And if you factor in the things that we look at, then it might be closer to 2016 than to 2020. And that's very close. And you've got to compare that analysis, which is quite bearish for Chinese demand for coal, with what some of the pure play coal miners are suggesting here, and what the assumptions they're using are, which are much more ambitious, much rosier for Chinese demand. And this is important, not so much because, it's not so much about, the amount of coal going to China from Australia. It's really about China's impact on the price of coal, because it's the price setter in the Pacific. So that would have a big impact on Australia if that softening demand happened, which I think seems very likely. And to wrap up, I think it's just worth emphasising that coal producers in Australia are already under pressure. So there's research from Wood Mackenzie that suggests that half of Australia's coal mines would operate at a loss if the price of coal was below $96 a tonne. I had a quick look when I arrived here last week, and it was around $82 a tonne. So there is that existing pressure. You have that likely story of less demand from China, which would have a big impact on projects. The other thing, the interesting thing is, if these projects did happen, so if some of the big mega mines in Queensland happen, for example, they're so big that their exports of coal would reduce the price of coal. They would have a big impact on the market. And so that throws up questions for, what does that mean for other mines that are operational in Australia? Might be the case that because these new mines happen, they lower the price and negatively impact existing mines. So you have a situation where politicians, representing constituencies of existing coal mines, might be going to Canberra and advocating the development of new mines that would then negatively impact the constituencies. It's kind of interesting thing to observe. And there's a question about, what is the national economic strategy in Australia, and what's the role of natural resources in mining? And I've had a rather amusing couple of weeks talking to people about all of this, and it's obvious, I'm sure you know it, but I feel I have to point it out, that obviously heavy dependency on natural resources does have a significant impact on other sectors of the economy, because it pushes up the value of the currency, and that impacts manufacturing and services that you might export in the wine industry and tourism, and basically erodes your underlying economic potential. So that's a big question and something that needs to be addressed. I've consciously left the climate change, local environmental impacts associated with expansions and new developments to the end, partly because I know you know the significant implications that they would have, and I wanted to emphasise the economic case and the investment case that I think needs to be made more regularly. And I think it's probably best for me to wrap up now and look forward to questions. Thank you.